Hi, my name is John Vance, president and founder of Vance Wealth. Our topic today is Bitcoin as an investable asset. Can we do this responsibly? So I am going to run into a topic that is probably going to confuse most of us. I will tell you that I'm trying to learn as much as I can in the space. This whole idea of cryptocurrency, digital assets, blockchain technology, Bitcoin, Ethereum, and really looking at, okay, is this an asset class that we should be considering for our clients? And so the talk of today is going to be Bitcoin as an investable asset. Can we do this responsibly, right? So that's what we want to look at. And so before I dig into some of the heavier content when it comes to digital assets is, when we think about broad diversification, it's really important that we identify what are those asset classes that are out there? What are the choices where are the places we can put our money, right? So first place is you can put it in a bank, right? You can put it in savings account, you can put it in CDs, you can put it in cash instruments, right? So you have the bank. Then you have investments like bonds, right? Where you own a bond portfolio that generate a fixed return, which is more of a debt instrument. Then you have stocks, right? So those are investments that are known as equity. Then you have real estate investments, right? Those are equity plus some income based on rental properties, right? And then you look into alternatives, which the alternative bucket is pretty vast. The ones that I think come to mind the most would be things like commodities. So owning gold exposure, owning oil exposure, timber exposure, things that are commodities. And so at the end of the day, it wouldn't be fair to say that there's like a one size fits all or that one of these investments does anything the best. The key of building wealth, building a portfolio is how do we diversify the portfolio and putting assets in there that over time will grow, over time have some level of safety, over time have some protection against inflation, and over time have some non-correlation, which means they don't all move together. So when we look at digital assets, Bitcoin being the most well-known, is we're looking at this, is there a place for this in the portfolio? Can it provide some diversification benefits? And that's what we're going to discuss today. And as we go through, I am going to move through some of these slides. As we start to look at what we call the history of global commerce, I mean, I know sometimes it's funny to even look back and see like, okay, well, what did global commerce look like? Well, we had the advent of fire, then we had the advent of the wheel, the internal combustion engine, the internet, and now blockchain technology. So this is literally where commerce is heading. And the more I learn about what's happening behind the scenes at banks and at big financial institutions and seeing how they're adapting this, we're in the very early stages of some major disruption that's occurring. But that's how you should think about global commerce: is this blockchain technology, and the use of digital assets sits on this blockchain technology. One of the things that I think is important is like, why is this a big deal? And if we look right here, most importantly, so it basically eliminates the trust industry and creates an authentication industry. So the way blockchain works is basically, it's a technology where data can get uploaded for free. And so then it becomes this authentication industry where, you can see the note here, trust industry equals intermediaries, aka middleman. So what blockchain is basically threatening to do is getting rid of a lot of the middlemen, which you can see down here. Intermediators employ 10 million workers, account for 21% of the US GDP. So to what extent that this will be that disruptive is unknown, but you can see there's lots of intermediaries and everything. If you buy a piece of real estate, if you get a loan, so you can see the list of industries that are going to get disrupted based on blockchain technology: commercial banking, our industry, securities industry, insurance, real estate, brokerage, legal services. So that's why this is a big deal, because the way we transact business is going to be different, because it's not going to rely as much on intermediaries, because the blockchain technology is going to allow for authentication versus just trust. When we then look at getting into what does this mean, I don't want to spend a lot of time here because frankly, I don't want to lose you in some of the nuances, but essentially when you start thinking about, there's all these different layers of digital assets, blockchain being the outer layer, and then as you drill down into Bitcoin, Ethereum, and some of these other areas, these are all going to be unfamiliar terms to you as you start to build that knowledge base. But just know that the Bitcoin technology, the Ethereum, this is just we're in early stages of this, and so that's why we're considering this for investment inside the portfolio, and albeit at a fairly limited scale. So let's talk a little bit about this. So why is it coming up now? Well, as of this year, you are able to buy an ETF, so an exchange traded fund that can invest directly in Bitcoin. And actually, as of today, so today is July 23rd, you can buy an Ethereum ETF, which basically gives you exposure to the price movement of the Bitcoin or of Ethereum markets. And so I want to walk you through just the case studies for this and then how we can apply this and maybe do this responsibly. So Bitcoin can be seen, so why Bitcoin, right? So Bitcoin can be seen as a store of value that can be used as a payment or remittance vehicle. That's number one. Number two, Bitcoin can be seen as a synthetic hard asset with a fixed supply, so like a physical commodity. Sometimes people will call Bitcoin digital gold because it's this fixed. There's a fixed supply out there. It's not an infinite supply. And then number three, Bitcoin may offer portfolio diversification benefits, which we're going to get into those. Okay, so opportunities in Bitcoin. So when we look at it, like, well, what are the opportunities that are out there? So if we're going to use it as a diversifier, how should we be thinking about it? Well, near-term opportunities. So why are people investing in it? So, you can see some of these bullet points here. Protection against currency debasement and inflation. This is a big one, right? I think generally people are concerned with U.S. governments and governments around the world about continuing to print money, continuing to borrow money. And so this is designed to potentially be an opportunity against protection against the currency debasement and inflation, protection against geopolitical risk, and then also just faster and cheaper to do cross-border transactions around the world. So that's really the near-term opportunities. Then we look at medium-term opportunities in Bitcoin, faster settlement, and cheaper point of sale. So basically how as a payment solution. So that's one of the things that I think is really early, but one of the medium-term solutions is really using this as a payment solution. And then long-term opportunities, recognition as legal tender for additional countries struggling with currency debasement. I mean, we know in the U.S., our U.S. dollar is extremely strong. So we are confident about keeping our money in banks and keeping our money in dollars. The reality is most other countries don't have that same benefit. And so a lot of other central banks and countries are starting to look at utilizing this, and even citizens in these countries are utilizing this to to help against this currency debasement that's happening in a lot of other countries around the world. And then reserve currency for countries seeking neutrality. So there's definitely some opportunities. As we get into, we don't have a lot of data. So this chart shows correlation of Bitcoin specifically to major asset classes. This goes back to 2014, right? So this is a 10-year chart of looking back and saying, how has Bitcoin been correlated to the S&P, to the NASDAQ, to gold, to the US dollar, and to bonds? So we have a chart here. So basically, you can see Bitcoin's correlation to the S&P 500 is 0.17. So correlation of 1.0 would mean perfectly correlated, which means if the S&P goes up, Bitcoin would match it. So that's a 1.0. So when you have a correlation of 0.7, that's a very low correlation. So you can see Bitcoin has low correlation relative to the S&P and to the NASDAQ. Even lower to the gold. It's negatively correlated to the US dollar. So you can see as a diversification tool, and again, this is using past history. We don't know what the future is going to hold, but as a diversification tool, Bitcoin actually provides a lot of those benefits because it doesn't move in line with what's happening in the other markets or other assets that you might own. One of the things that I did find interesting is we know Bitcoin is wildly volatile. We've been through periods of time where Bitcoin's gone up 1,500% and then down 80%. So Bitcoin definitely is extremely volatile. And this chart basically shows the Bitcoin volatility versus leading tech stocks 5 years post their their initial public offering. So basically what this shows is annualized return is on the y-axis, and annualized risk is on the x-axis. And so you can see annualized return of something like, let's call Netflix, over the next 5 years was up north of 60%, and with a certain level of standard deviation volatility here. And then you can see Bitcoin as slightly higher with more volatility. Look at Amazon, much higher return with a lot more volatility. Google, more volatility, less return. So this just is designed to show you that some of the volatility that we're seeing here is a little scary, right? Because it's coming from an asset class that a lot of people don't understand. But when you compare it to volatility against a bunch of familiar names, it's actually it does mirror some similarities to these leading tech stocks that we see today. There's a lot of data on here, but one of the things that we also wanted to do, and this was courtesy, I believe that Franklin Templeton provided some of this research for us that we're utilizing. So it just said, you know what, if we have a 60-40 portfolio, which we would call in our world a balanced portfolio of 60% equity and 40% in fixed, like what would a portfolio look like in terms of return expectations if we had Bitcoin exposure? And this is just looking at the last 5 years. And again, past performance is not indicative of future results, but we just wanted to show you an example of the last 5 years adding Bitcoin to the portfolio. It also is assuming that this is not preference for any tax treatments. And then this also assumes quarterly rebalancing. So one of the things with Bitcoin, because of how volatile it is, having regular rebalancing is going to be really critical to make sure that it tampers down some of the volatility. So there's a lot of you have basically the returns on portfolio one. So on the left hand side, it shows a 60% stock, 40% bonds, 0 Bitcoin. Portfolio two is 58 stocks, 39 bonds, and 3% Bitcoin. So just wanted to give you an idea of, okay, if you use the portfolio. If you use these two types of diversification tactics, and then you see the rates of return, I'm just going to use the since inception number. So that portfolio one has averaged just shy of 9%, portfolio two of just over 11. And that's only with a 3% exposure. And it's mainly because Bitcoin has gone up quite a bit. And so I do think the returns on a go forward basis will be a little bit more muted, but I do think that there is some value there. And then we get into things like performance risk statistics around what does this actually do to the portfolio in terms of standard deviation, Sharpe ratio, upside downside capture ratio. I'm not going to bore you with all the details, but what I found interesting is that let's look at standard deviation, which just measures volatility, right? So the higher the standard deviation, the more the volatility in the account. And so if we look at standard deviation with 0 Bitcoin and with 3% Bitcoin, it's pretty close, right? It's 12.7 versus 13.1. So pretty minimal, but it does generate some upside. So this data would suggest that if this repeats itself, that this could be a good diversifier within a portfolio. And a very simplistic look, but just wanted to share with you what that would have done over the last 5 years. As we start to look at, okay, what should we be considering? What do we? Uh-oh, it says my internet's unstable. Hopefully, I don't have any issues. We want to make sure we understand how it fits into the portfolio. Does it replace alternative assets like commodities? Does it replace some of our equity exposure? So that's definitely something we want to consider. We do need to understand, assess market capitalization, like how big is this market? It's pretty small right now. So at the beginning of the year, it was about 800 billion, which is about a little bit over 1% of the fixed income market and about 2% of the equity market. So it's a pretty small part of the market, but it's something that obviously we want to be mindful of. This will be part of the slide deck. There's far too much to read into this, but basically one of the reasons why we're having the conversations with clients that we're doing this webinar is that because there is a spot Bitcoin ETF, which means spot, which means it tracks the pricing of Bitcoin, is that it's a very accessible vehicle. Again, there's a bunch of notes in here, but the middle one is basically using an ETF structure to hold Bitcoin allows us to have access to put it inside portfolios like IRAs, Roth IRAs, 401ks. So it just makes it very accessible, and it takes away some of the challenges that you might have if you're trying to buy Bitcoin directly through an approved custodian. Again, the spot, it gives us much easier access. We are seeing pretty low fees when it comes to it. So I think a lot of I don't want to go into specific recommendations on the ETFs that we're utilizing, but they're a really low cost right now that we're seeing in terms of using ETFs versus actually buying Bitcoin directly. Some of the risks, though, that we have to deal with, it's really not a regulated asset, which does provide some problems for us. So it's not regulated. We do think that this next administration is going to need to deal with the regulatory complexities because it's basically going to be too big of a market area to avoid. And obviously, we want to provide some leadership in this space. So I do think we're going to have the next president and Congress tackle this and figure out what needs to happen. What is the U.S. regulatory framework? Because in my opinion, there will be. One of the things that's really hard is we don't have a big track record. We're talking about track record data that goes back 10 years. this asset's, 20, I don't even think 20, it's not even 20 years old yet. So we're going to there's a lot of volatility. So valuation is a tricky one when it comes to Bitcoin, which I think is why a lot of people just avoid it. It's like, I don't understand it. I don't really want to own it. And that's why when we start talking about it, it's like, well, what is the proper allocation? And so this is just a screenshot that I took from just a company that we work with in terms of what are people predicting. So right now, Bitcoin is, I believe, just shy of $70,000 per Bitcoin. And you're starting to see some pretty bold predictions where people think that we might see this move upwards and 150, 250, 300 higher. We have some firms out there that you can see ARK Investments predicting over $1 million. So these are all just predictions. At the end of the day, nobody knows. But there's a bunch of real world applications that are going to rely on this network. And so we know this is going to continue to grow, but it is a little bit hard to understand. And that's why when we start considering it, we have to be very modest with our approach. And so how would we look at things if we were going to try to be responsible around owning digital assets, owning specifically Bitcoin and Ethereum? Here's just a couple things that we want to lay out. Is if you're not comfortable with 100% loss, do not invest. I mean, that's just the short, that's the quick answer, right? Is the reality is this is an asset that can go to zero. Now, when we start talking about a portfolio, if you invest 1% and it goes to zero, that's not going to have a dramatic impact on your overall returns because it's just 1%. So when we start putting in some guidelines as to, and I think that's a doomsdayer. I don't think we're going to have 100% loss, but I think we do want to start with that because we are very new into this environment, and so we want to recognize that that is a possibility. And then if you're open to diversifying and utilizing this in the portfolios, these are a couple things that we would think about. Is that you should be willing, or we might be willing is probably a better term, up to 1% of your total net worth. So whatever your total net worth is, if you're worth $10 million and you put 1% in, that would be $100,000, right? So I think it should be it can be up to 1% of your total net worth. You might even think about it as 1 to 3% of your investable assets. And so that would be your brokerage assets, your retirement assets, and so 1 to 3%. And then if you want to drill down to the portfolio level, is that depending on where you want to own it, is maybe 1 to 5% of any individual portfolio value. And probably keeping all three of those as an objective is a good way to provide some framework. And so one of the things just to know, you see the disclosure at the bottom, every investor has a unique set of financial considerations and risk appetite. So obviously talk to us before we decide if this approach to crypto investing is appropriate for you. These are going to be conversations that we have, again, as a diversifier, as an alternative asset. And the reason why we're bringing this up is this is going to be more mainstream, more headline. And so we want to be that voice that provides the resource to you and potentially the opportunity, and just so that we're aware of what the options are in the account. And so if any of you are on this and want to welcome the conversation, this definitely will be on the agenda for our year-end planning. But feel free to reach out to the firm if you have some questions that you'd like to address sooner than later.